Assalamu alaikum friends, welcome to question number 29 of SBR from your revision kit, Kaplan revision kit, and this question also featured in March-June 2019. So I'm not going to read the question, okay? I have read the scenario, I'm just going to explain what the scenario is all about, and then I'm going to show you how to attempt this questions. I'm not going to write the whole answer, but I'm going to show you the points that you can use when you're facing this type of questions in your exam. So the first question is for 6 marks, and here they are talking about whether the company is in a joint arrangement or not according to IFRS 11. Okay, whether you should account on as a joint arrangement under IFRS 11. So for this type of question, how do you start? This is for 6 marks. Okay, if you see the answer is plenty big enough, right? It's very big. You're not supposed to write so much. So how can you learn from your revision kit solutions if you know that you don't have to write so much? There is one technique that you can apply, and that is effective for all your ACCA papers. Break down it into number of points that you need to write, number of paragraphs that you have to write, okay, and the points that you are going to write. First, make a rough point. On that, you can make up the sentences. It should not be exactly the copy paste of the revision kit solutions, but you can see whether it's correct or not, the point has been mentioned or not. Okay, so, and this is a very popular exam topic, control or joint control, which is your part A. So how do you attack this type of question? This is A, right? Just give me a first part of A. Okay, there is a second part of A relating to crypto. Okay, so this is first part of A, and this is for joint control, whether joint arrangement exists or not. So to do this type of question, first you start with, okay, number one, you start by defining whether control is there or not. Before you go to joint control, remember, whenever you get this type of question, not only this question, the nature of this question is this, that you first have to explain defining what is control. So definition of control. According to which standard? Which standard you have to use? Because for everything you have to use a standard, IFRS 10. Then second, because first you have to see whether it is defined as a control or not. Because if it is defined that yes, there is a control exists, that what does it mean? It means he's a subsidiary. It means he's a subsidiary. So if he's a subsidiary, he cannot be a joint operation or a joint venture. Hence, there is no joint arrangement. So IFRS 11 does not prove. But if IFRS 10 is not there, if control is not there, so the word here is control. Then we have the second step is start defining whether joint control is there or not. So definition of joint control. According to what? IFRS 11. If it is so, then there are two options. It could be a joint venture or joint operation. If it is joint venture, you need to use IS 28, equity method. Okay? This is all you have to write in your sentences, in your paragraphs. I'm not writing the whole answer, but I'm just showing you the breakdown of it. If it's joint operation, then IFRS 11. You have to take the proportion and all, the joint proportion of revenue, cost and all those things. Now the third step. You might not reach to that third step, but it depends. If it's not a control, if joint control is also not there, then comes associate. Whether it is an associate or not, definition of influence. So that means associate, he is an associate or not. If associate, equity method. Okay. Why? Because in the scenario, he has 45% share. The share that he has is 45%. I'm talking about crypto. crypto has 45% share, so that 45% is less than 50%, right? But sometimes it can happen so that having less than 50% also mean you can still have a control. How? Maybe you have the power to make decisions, key decisions, right? Maybe the other shareholders, they are having a very small amount of shares, so that together they cannot make up a control. In that case also you can be a control. Let's say you are 45%, okay? Other shareholders are having 1% each, or not even 1%, less than, let's say, half a percent. So if you combine all the half a percent together, it will not add up to 50%. Hence, you are a subsidiary in that case. Next, joint control. Whether you have joint control or not, you need to look at the scenario to answer this. If it's not a joint venture, because 45%, no? So with 45%, it falls within the range of 20 to 50%. So it could be an associate. It could be a joint venture also, sorry, joint control also with 45%. Okay. Now let's see the answer. So this is the basic way of answering this type of question. This is the layout. So through this layout, you can understand another thing. What is it? This is for 6 marks. So this 6 marks you can divide along the 3. One is control, the other one is joint control, the other one is associate, influence or associate. So you can, so 2 marks for each. So you can write it in 3 different paragraphs. First paragraph, okay, I will be talking about IFRS 10, whether control is there or not. Second paragraph, leaving one line. Now you have to type, so you leave one line and type IFRS 11. Use from the rule of IFRS 11, whether it will, and you have to apply to the case. And third para, IAS 28. Since there is no calculation, you don't have to calculate the amount of subsidiary, joint venture or associate. No, you just have to explain it. Okay, so 6 marks, in 6 marks they will not tell you to explain also and do calculations also. Now can we see the scenario briefly before I take you to the actual answer? I'm not going to read the answer, but I'm just going to show you how the answer is. So if you see here, okay, he owns 45%. The rest all owns the remaining 50%, 55%, and 18% is the largest, held by any one of them. Okay, and the important part is the second part. What business is involved in, all those things are not so much important. What's important is regarding major decisions. Okay, so crypto can dominate up to 4 of the 8 board members. Okay, and each of the remaining makes the other 4. Out of the 8, 4 is made by crypto, the other 4 is made by the other shareholders. And for any major decisions, okay, there has to be a clear majority. But crypto has the power of veto on any major decision. That means if he want, he can stop any decision from taking place. He has that power. There is no shareholder agreement. This is very important, that he has no shareholder agreement. That means how the operating decision will be taking place. There is no agreement about it. So the directors believe that they have a joint control. Now you have to say whether they have the joint control or not, because they told since crypto has a power of veto, so only they are basing their decisions on this one, that they have a crypto has a power of veto over major decision. That's why they are concluding that this is a joint control under IFRS 11. Now you have to say whether it's a joint control or not. Okay, so these were the steps I've showed you. Now let's look at the answer. You see, you need to use a subheading also when you're using different paragraphs. So this is about joint control. So before you assess, you have to go through IFRS 10. IFRS 10. That's the first step. Okay. Now, so second paragraph is what? IFRS 10. Here we are talking about IFRS 10. What are we talking about IFRS 10? That we are stating what is the control under IFRS 10. So what is the definition of control? It requires power over the investee, which gives the investor ability to direct the relevant activities. These are the keywords from IFRS 10 only. Some words you cannot change. Some words you have to write as it is only, like power over the investee, ability to direct relevant activities. These are the keyword. Okay, so now this Up to this much is from IFRS 10. Now you link this to crypto. Okay, does crypto have that ability? No, crypto does not have the ability. Okay, crypto does not have the ability to direct the relevant activity. It can only block decisions. Remember, only veto. Okay, and also he cannot make any decisions by himself. Cannot make any decisions. So these are points. And also there is no shareholder agreement also regarding voting rights and obligations and all. Okay. So if there is no shareholder voting rights and all, that means what other shareholders can prevent crypto from making decisions in its own interest. Okay, other directors can come and stop him. So this shows crypto does not have control over current. Final one line of conclusion you need to write whether control is there or not after giving all the facts from the case study. This in between the middle part of your sentences will include all the facts from the case study. He does not have shareholder agreement. He can block decisions. He cannot make major decisions. There is right. Last line you have to give. Finally, what is the conclusion? Conclusion is no control. Now let us go to the second one. Okay, IFRS 11. Because no control means let's see whether he has joint control or not. So joint control definition you need to start. Immediately start by defining. Don't waste your time. Okay. So these are keywords. Okay. It has to be contractually agreed. There has to be some form of contract, and it has to be agreed between the parties who is sharing the control. Okay. So sharing of control, and the other one is unanimous consent. This is a very keyword. For taking any decisions on relevant activities, unanimous consent of the parties are required. Okay, so in this case, now you after this you are linking into the case study. Okay, so here they did not say anything about unanimously. They have not mentioned anywhere. So that's why this is not a joint control also. Okay, if more than one combination of parties is possible to reach the required majority, remember, then it's not a joint control. To have joint control, only one combination can be there, not multiple combinations. So joint control is not there. Now let us go to the third one, IS 28. Remember, don't stop there. Because you thinking that you have answered, they asked whether under IFRS 11 it will be joint arrangement or not. You said it's not a joint arrangement. Don't stop there. What is the correct treatment? That correct treatment you have to tell. It might be under different standard. Okay, otherwise you will not get the full mark. You will only get 4 out of 6. You will lose that 2 marks for saying the correct treatment. Okay, because the requirement asks you to advise the director how the above issue should be accounted for. How it should be accounted for. Correct treatment you have to give. Okay, so IS 28. What are we mentioning? Definition of influence. Significant influence. He has a significant influence because it is within the range of 20 to 50%, 45%, right? Someone who wants between 20 and 50, it is considered a significant influence. Okay, so therefore, Kuran appears as an associate. Therefore, you have to use equity method. Okay, in your consolidated financial statements, you have to take it as an associate and use equity method to calculate the value of associate. That's it. That's it. But if you follow this, it will be very easy for you. Where was it? This method which I have done here. This you can do for every question. What are you going to start? What will be your first paragraph? What are you going to write? Second paragraph, third paragraph. And for how many marks? You have to divide it accordingly. Okay, for 6 marks, you have to write about 3 different issues. IFRS 10, IFRS 11 and IAS 28. Now, let us go to the second question, which is second part of A. And this is also for this is for 5 marks, and most of the students struggled in this part because it was about embedded derivative in IFRS 9. Because I told you financial instruments, IFRS 9, the area that is mostly that students get for their exams are 2 areas. One is financial liability versus equity. Whether you have to account a loan, something as a under equity or a financial liability. Another question is embedded derivative. These 2 areas are very common. Oh yes, another one is impairment of financial assets. This does not come very frequently, but it has a very high chance of coming. Okay. Now, so this is about, this question is about, I'm not reading it, but I will just tell you the backstory of this. This is about a contract where they want to buy electricity. Okay, for 20 million. So electricity for 20 million euros. Okay, and their functional currency is dollar. Both crypto and the supplier, their functional currency is dollar. Now this is about whether they have to separate. Embedded derivative means what? There are two contracts in one. One is derivative, the other one is not a derivative, right? So whether you have to separate out or not, that's the question. Okay, because this is regarding foreign currency also. Why? Because their functional currency is in dollar and this is in million euros, fixed quantity at 20 million euros. So there are two contracts here. Can you see? One is electricity, one is 20 million euro. So that 20 million euro comes as a derivative contract. So there are two. That's why it is known as embedded derivative. You can understand. In one contract, it might look like this is a contract for electricity. No, it's two. Derivative plus electricity. So they told that they are going to measure that foreign currency, the embedded derivative, is measured at fair value through OCI. Whether it is correct or not, that also you have to say. If you are very good with embedded derivative, you will know that this is not correct. Why? Because derivatives are measured at fair value through profit and loss, not other comprehensive income. Okay, this is the answer I am telling you. But definitely when we go to the answer, to reach to that step, you have to follow some more steps before. You immediately cannot write that this is wrong, it has to be measured at fair value through profit and loss. No. But remember, on 31st December 2000, later, there was a contractual modification. There was some modification to the contract, this contract for electricity. Now it became an executory contract. An executory contract, we know it is outside the scope of IFRS 9. Right? And this is denominated in dollars, you see. This was in 20 million euros. Now it became in dollar, the executory contract. It changed. Okay. So embedded derivative had a negative fair value of 2 million euros. Can you see it's in euros? Then the fair value. So the directors would like to advise as to whether they should have separate out the foreign currency derivative and measured it at fair value through other comprehensive income, and how to treat the modification in the contract. Two questions are there. One is how to treat the modification. The other one is whether they have to separate it out and measure it. So there are three things if you see. First one, should they separate out, right, the embedded derivative from the contract? If they separate it out, should they measure it at fair value through other comprehensive income or fair value through profit and loss? Third, how to treat the modification in the contract. So there are three things and for 5 marks. Okay, because the question is here, advise the directors of crypto on how the above issues. So above issues means both these two issues. Okay, and the split of mark is given 5 marks. With reference to relevant IFRS standards. So which standard will come here? IFRS 9. IFRS 9. Okay, so now let us see the answer. Okay, so the answer is embedded derivative. Okay, just okay. So now, first of all, number one step, I'm writing on the sideways, I'm writing my answers only, my points. Okay, how to start this answer. Definition of the contract. Number one, you start by defining what type of contract it is. You start by it. So this is a hybrid contract. It's a hybrid contract. Hybrid contract means it has two things in one contract. One is electricity, one is 20 million euros, right? Number two, you see, contract is a hybrid contract. They start with this. So in this contract, it has two things. One is what? This hybrid contract is spread out in two things. Okay, this will come as number two. What is it? One is the electricity. One is the 20 million euros. This 20 million euros is a derivative. Okay, and this is a non-financial. This electricity. How do you deal with this? Exactly, that's what they are writing it. Whatever I'm doing on the right side, that's what they have written. So electricity, this is known as what? There's a name for that when there's a hybrid contract. Host contract. Host contract. Don't forget this word. You have to mention this word in your answer. Electricity is the host contract. That means the main contract is electricity only. That other one comes along with it. So the hosting, the one who is hosting is what? Electricity. Host contract. Okay. And this host contract is an executory contract. Why executory contract? Executory contract means when neither of the party are performing their obligations. The electricity, the one who has to buy is not buying, the one who has to sell is not selling yet. They are going to do it in the future. They have not bought or sell, so they didn't. None of the parties performed any of their obligations. That's why it is known as executory contract. Okay, to purchase electricity at the price of 20 million euros. So another word, let me write as executory contract. Usually such type of contracts are executory contract only. Even in your exam also you will see coca, to buy chocolate, to buy coffee beans, to buy electricity, coal, to buy coal, this type of executive contract, because mostly they don't perform. It's something to do in the future. Yes, in the future if they perform, then it's not an executive contract anymore, then it comes under the scope of IFRS 9. But executive contract are outside the scope of IFRS 9. Okay. So the contract also contains an embedded derivative. You have to mention this. First you talked about host contract number 1, second you talked about embedded derivative number 2. So number 2 is what? Embedded derivative. It comes from here. It's an embedded derivative. That is also included there. Okay. What is that embedded derivative? You have to write it. What is the embedded derivative part? To sell dollars in the future to buy 20 million euros. Make sure that you write it. Let me highlight it for you. Okay. We know the executor contract. The host contract is what? Electricity part. What about the embedded derivative? Embedded derivative is to sell dollar in the future to buy 20 million euros. See, you want to buy electricity at euros, 20 million euros. So to buy that 20 million euros, you have to sell dollar. Okay. Because your derivative is in dollar. You have to sell dollar to buy 20 million euros. Functional currency is dollar. If you're not understanding again, let me go through that to show you. Because most of the people will be confused why selling dollar and all. Then I will get in my comment section asking that doubt. So let me clear that doubt also. So here, what is it? We are not taking the impact of the contractual modification when that derivative was not there. We are still didn't reach there. We are still in that first part only when they have both the contract together. So the functional currency is dollar. Okay. Functional currency is what? Dollar. Of both crypto and this one. So you sell. What do you need? You need euros. Okay. So to buy euro, you have to sell dollar. That's it. That's how a derivative works, right? You have to sell one currency to buy another currency because you have to buy electricity at that amount. So you need that amount. Now, very important, whether the host contract is a financial asset or not. I have written it here. It's a non-financial asset. Okay, non-financial asset. Very important whether it's a financial or non-financial asset. Then it changes. It's a non-financial asset. Now the host contract, that means the electricity. Electricity is not a financial asset. Okay, so because this is not a financial asset, now you have to what? If it was a financial asset, no problem. Use IFRS 9. But this is not a financial asset because see, IFRS 9 deals with what? Financial asset, financial liability, equity instruments, right? But if it's not a financial asset, then how do you deal under IFRS 9? So just keep it as it is. Let us go. Because you need that, whether it's financial asset or not, to separate in order for you to decide whether you have to separate it from the embedded derivative or not. So embedded derivative is only separated if the economic characteristics and the risk of the embedded derivative are not closely related to the host contract. That means the risk is different, economic characteristics are different. The host contract and the embedded derivative. Okay, let me do it here for you. Risk and economic. This answers you have to write, by the way. Okay, risk and economic characteristics are different, then you have to separate. So risk and economic characteristics of two things are there. One, embedded derivative. Okay, we said embedded derivative only because derivative is embedded in that contract, host contract. The other one is host contract, that is electricity. Okay, So risk and economic risk of these two are different. Then separate. Then you have to separate. If it's not different, then you don't have to separate. You can keep no similar risk. You can keep them together. It's like how a similar type of product sold in a similar location, we aggregate in our segmented reporting, right? We segment them together in a group because they're similar type of product. We are selling to the similar type of customer in the similar location, so we can aggregate. We don't have to show it separately. So this is also same. If risk and economic characteristics are similar, you can keep them together. No need to separate. But if it's different, then you have to separate it out. It's better to separate it out and then account for each of them separately. Okay. The reason why, because embedded, the host contract is not financial asset, electricity, you know. That's why this separation and all comes. Otherwise, if it was a financial asset, derivative is also under the financial instruments only. So both you can keep them together. Then that issue does not come if it was a financial asset. Because both can be dealt under IFRS 9. But this is the problem is electricity is, and most of the time this type of questions only you will get where one of them is not a financial asset. So that they can ask you this question whether you have to separate out or not. Now I hope that it makes logic to you, right? Why it needs to be separated out and not, but we still didn't reach to the conclusion. Okay. So in this case, it would likely to be the case in this case. Why? Why? Why is the question? I'm asking you why. Make sure before you come to this point, you go through that case study several times before you actually understood what the question is trying to ask. I've told you financial instruments, it looks tough from outside, but once you go inside deep into it, it's very easy. It's the easiest. Trust me when I'm saying this, because this question which you are seeing there, this was the paper I did. I got this question only. Thank God I was prepared well enough for this question. Right? So, because neither party has the contract, to the contract as a functional currency of euro. They don't have euro. Both of them have in dollar. If it was in euro, then risk and this economic characteristics would be similar. Why are you saying it? Okay, I will show you here. Wait. See the contract that it has 20 million euros, right? But their functional currency is in dollar. So dollar and euro, do you think they have similar characteristics and their risks are same? No, they're two different currencies. So their risk will be different, their economic characteristics will be different. That's the reason. If their functional currency was euro, there is no risk. The risk is similar. The way that will perform, this also will perform the same, no? Both are euros. But in this case it's different. That's why that risk is different. That's why it's not similar. So that's why it makes more sense also that you have to separate out the host contract from the derivative contract, the embedded derivative. Okay. Because the functional currency is not euro. Neither party, both of the party has the crypto as well as his supplier, the one who's going to supply him the electricity. Both of them have the functional currency in dollar, which is different from the contract. In the contract, it was 20 million euros. So the contract and the currency, the functional currency, they move in a different way. Risk is different. So it is acceptable to separate the embedded derivative. But at least we reached to 1/3 of the answer. We still didn't reach to the final answer. Okay. We have to see whether it has to be measured at what. What did they say? It will be measured at fair value through other comprehensive income. No, it's wrong. Okay. After you separate, it has to be measured at fair value through profit and loss rather than this. That's the correct treatment. After you separate out, if you don't separate, if you just have the derivative only, that also you go and check for derivative this thing. It will be fair value through profit and loss. Right? Not fair value through other comprehensive income. You have to be very clear on this thing. So up to this we finished. Now we are taking the impact of the modification of the contract. Modification means there is no embedded derivative. Only host contract is there. That embedded derivative is taken out from the contract. So now what should you do? Okay, so after this are different then separate. Okay, so after separate, measure at fair value profit loss. Fair value to profit and loss. After that comes modification of contracts. Modification of contract means in this case no embedded derivative. Embedded derivative is taken out. So what are you left with? Only executory contract. Only the host contract, that is the electricity. Right? Let's see. And you have to write this in different paragraphs. The modification part, the before modification part. Okay. Now, see, it is not mandatory. Okay, it's not mandatory that you have to separate. But if you are not separating it out, if you are keeping them together, still you have to measure it at fair value to profit and loss. Remember this also. The entire hybrid contract you can measure it at fair value to profit and loss. Okay. Now, when the contract changes, one thing you have to look for, whether the contract has significantly changed or not, whether there's a significant change in the contract or not. So in this contract, there's a significant change. Why? Embedded derivative is only not there. It's totally taken out. No embedded derivative. It only includes executory contract. That electricity is only there. Okay, let us read the scenario once again. Let us go through that, where they say that electricity is no longer there. The contract is now an okay, let me highlight it. The contract is now an executory contract denominated in what? Dollar. So now you see functional currency is in dollar. Now the contract is also in dollar. Okay, and no more embedded derivative. No more embedded derivative. So we know executive contract are outside the scope of IFRS 9. You should know this. You have to mention it also. Executive contract are outside the scope of IFRS 9. So how are you going to measure this? You cannot measure it. You cannot measure it because it's outside the scope of IFRS 9. So forget about executive contract. Now let us go to the embedded derivative. Remember, when something is out of a contract, don't just ignore it. Whether it is financial asset, whether it is your asset, non-current asset, whether it is your tangible asset, intangible asset, any asset, when you're selling it out or when it's no longer is there, what do you have to do? De-recognize. You have to de-recognize, simply de-recognize. Alas. What do you have to de-recognize? Embedded derivative. This embedded derivative component only has to be de-recognized, not the whole contract. You'll be having the executive contract. But you don't know how to measure for it because just simply write outside the scope of IFRS 9. Because you don't know how to measure it. Neither you will be asked to measure it because it's outside the scope of IFRS 9. Embedded derivative, you have to account for it separately, and then you have to de-recognize it separately from the executory contract because it's no longer there. So that's it. Now let us go to the part B. Part B is about lease accounting. Right? Earlier there was a different standard. Now the standard has changed to IFRS 16. So there are two questions regarding this. First question is saying you, because there are some criticisms and all in the before standard for leases. What was it? I don't remember the standard. I think it was IAS 17. Yes. What were the criticisms? Remember, this was a current issue then. Okay, current issues can always come. You have to be prepared for it. So this is one of that current issue. IFRS 16 leases, the new leases. Earlier, they were not required to recognize lease liabilities. The lessee, we know lessee accounting, they have to recognize right of use asset and lease liability. Earlier, standard does not include that. So that means most of the lease liabilities are ignored. Now, because of this, they have issued IFRS 16. So, first part is same, which is for 6 marks. Second mark is also for 6 marks, but in the second mark, you have professional marks also. Okay. So, first one is saying, what are the key changes to the financial statements which investors will see when companies apply the lease accounting requirements to IFRS 16. Lessee accounting. They are not talking about lessor operating versus financial lease. No, they are talking about lessee, right of use asset versus lease liability. So first understand that. Okay. And in lease, there are so many variations of questions that can come. You might be asked from the point of the lessor, from the point of the lessee, sale and lease back, right? Sale and lease back, that is not a revenue. Sale and lease back, that is a sale. Or like this theory part, where you might be asked to explain what is the impact of the changes in the standard. So this type of question, I cannot give you a set format that this is the type of question that can come, but a lot of questions can come from IFRS 16, because since it's a new standard, you can expect lots of questions from IFRS 16 in your SBR. Okay. So 6 marks, come on, tell me some of the key changes. Next part talks about ratios. They have given you the ratios also, so you have to show the impact on these ratios. One is earnings before interest and tax to interest expense, that means interest cover simply. The other one is return on capital employed. The other one is EBITDA. What is the impact on these three ratios of the changes in the IFRS 16? But the formula they have given you here, okay, this is the formula. In the bracket they give you the main ratio. So for a company with significant off balance sheet leases, for this type of company, mainly you have to discuss what is the likely impact that IFRS 16 will have on the accounting ratios. Remember, there's a comma. There is a comma. Can you see this? Comma means you have to write two things. One is the impact on the ratio versus the other one, the impact on the company, where there is a significant off balance sheet leases. Two things you have to explain for 6 marks. Okay, so don't go and explain the impact of the ratios in your first part. Keep it for the second part. First part, only what are the key changes and what would be the impact on the investors, which will investors will see. So first the key changes and then the impact on the investors also you have to see. Okay, let's start. So these are some key changes to the lessee accounting. As I was right, it was before, it was known as IS 17. There you did not have to recognize lease assets, right of use asset and lease liability. Now you have to recognize it. So one of the answer that you can write that one. So because of this, it will have an impact on what? Statement of financial position and your profit and loss account. Remember, you have, because they asked you to show the impact, right? So what does key changes? So one of the key changes is it introduces you to single lessee accounting. Let me write it here. Key changes to IFRS 16. Single lessee accounting. Two things you have to recognize. Right of use asset, ROU, lease liability under this new standard. So this you have to write in your answer. Okay, whether you give it in a separate paragraph or together, it does not matter so much. Okay, so first paragraph talks about that only, that you have to recognize right of use asset as well as lease liability. Okay, but lease liability you have to recognize two things, there are exceptions. Make sure that you write those exceptions only. One is short term, one is minimal value. When your lease is for short term means usually within 12 months, and the other one is minimal value. See, minimal value means does not mean that you are bringing something for 1,000, so that's a minimal value. No, it depends that when you're first time buying it, what is the price? For example, car you cannot take it at a minimal value, even though later years the value of the car goes down. But when you're buying it for the first time, the value of the car is too high, so that cannot be taken as a minimal value. So it depends, right? So with this two exception, you have to recognize lease liability almost for everything. Now, you have to give the method also. It's not enough to say you are going to measure lease liability, right of use asset. How are you going to measure the lease liability and right of use asset? So that how to measure right of use asset and lease liability. How do you measure right of use asset? Or let's start with lease liability. present value of the lease payment. Usually it's given to you. Okay, initially you measured this one and discounted at the rate implicit in the lease. Right of use asset, how do you measure? Right after that only you are writing. This is measured at the same amount as lease liability, but you add any payment that you have made on or before the commencement of the lease plus any direct cost. Okay. If you don't have any direct cost or anything like that, while you're calculating, I'm talking about, but when you're writing it, you have to write these things. But when you're calculating, sometimes you might not have any payment or you might not have any direct cost. That in that case, right of use asset will be equal to a lease payment, lease liability. Remember that. Okay. Now, remember, they are asking you how the investors will see this. You have to talk about investors also. Don't forget why students forgot this part. And hence, they got less marks for this, thinking that, okay, it's very easy. I will write this thing. No. They talked about how the investors also will see this differently. Okay, so investors have to think about some sector, because some sector will be affected more than others. Definitely, right? So they told what is the impact on the financial statement. So the previous material of balance sheet leases. As a result, companies with previous material, write the word material because they told significant of balance sheet leases. Material of balance sheet leases will report higher assets and liabilities now. Whatever before was there now, when you're recognizing it, it will record higher assets and liabilities. Why? Right of use asset will increase the asset. Lease liability will increase the liability. So this is the impact. Investors want this impact only. What is the impact on the assets and liabilities? Some more you can say. So another thing is more information. It introduces you more information, IFRS 16. Both in the statement of financial position as well as in the notes also. So second point, okay, this is the first point. Second one, more information. More info. Okay. So once you explain a point, don't just write in one paragraph, okay, more points, right? Better it is. Explain the point. They have built it up. That's how this paragraph became this long. They're explaining that point only. How more information in the financial statements and in the notes. Because now you are recording assets and liabilities. So that's why you no longer have to estimate the amount of assets and liabilities, because estimation will make you will give you incorrect figure. Accuracy will not be there. But now since you are calculating it, it will be more accurate. So you don't have to estimate it anymore. Okay, and this will have an impact on the ratios also. Don't mention the ratios now, but you can just say that now ratios you can calculate it in a better way, more accurate. Okay, so because of this, it becomes easier to compare. So easy to compare. Okay, another thing, easier to compare. So you can compare with those companies, okay, which borrow to buy asset. So the lease assets can be borrowed to those companies which borrow to buy the asset. Because the one who is borrowing, they are also recording assets and liabilities. The one who is having this lease asset is also recognizing assets and liabilities. Borrow means they are taking from a loan. They are taking a bank loan and then they are taking the asset. They are not going for a lease. So the one who is taking a lease, assets on lease versus the one who is not taking the assets on lease, now you can easily compare. Because for leases, you have assets also, you have liabilities also. Coming to IFRS 16. We are going to the disclose. Okay, this requires disclose. So disclose lease liability separately from other liabilities. Okay, lease liabilities had to be shown separately from other liabilities as a separate line item, because most of the fraud or whatever is happening is in the lease section only, so they can easily hide it. Or sometimes if they don't disclose it separately, they might say that we have already included the liabilities under lease liabilities under liabilities, but in fact you actually didn't recognize it because you want to show your liabilities less. Because if you include the lease liability also, your liability amount will go up, right? Hence it will be a problem for you later on if you want to take any loan or this thing, because your gearing also will go up now. So that's the reason show it separately. Okay, but you can show it together with similar liabilities also, if you think that in that way uh, the investor can understand the lessee's financial position. But if you have taken a significant amount of lease, it's better to show them separately. If the lease is not so much, then you can show it along with other similar items. If you think it's not so significant and it will not have a huge impact on the investor's decision, you can aggregate. But usually it is advisable that show lease liability separately. Now, that lease liability you have to split between two things: non-current versus current. It depends on the timing of the payment. If you are paying within 12 months, current; otherwise non-current. Okay, the lease liability. So after the lease commencement, they measure the right of use asset, right? How do they measure the right of use asset? Cost less accumulated depreciation, and also if impairment is there. And lease liability is increased by interest and it is reduced by the repayment. You have to talk about these things because we are talking about the impact on the financial statement. Remember, if your interest increases, if your loan amount increases or reduces, it will have an impact. That's why they are talking about it here. This will have an impact on the statement of profit and loss. How? That's why we are bringing out here to show the impact. Depreciation, exactly. Depreciation is charge, means your expenses will go up. Depreciation expense on the right of use asset. So this is normally presented as an operating expense, and interest expense is presented as a finance expense. Okay, so that means now, earlier how was it? In contrast, earlier you show everything as a full lease expense, as an operating expense only. There's no separation of this two. Okay, so that means now the expenses are less. Earlier they showed a full lease expense as an operating expense. Okay, that means before you deduct your interest and tax, earlier expenses are more. Operating expenses you deduct before finance cost. Okay, so if your operating expenses are more, that means your profit before interest and tax will be less. But under IFRS 16, it's not like that. Some of the costs are under operating expense, some of the costs are under finance cost. Because of that, profit before interest and tax will be higher now. Interest you will deduct later now, but before that it will be higher. Because under operating expense, you are not taking everything. The finance cost is separate, operating expenses already including depreciation expense. Okay, which is also known as profit from operation. This is likely to be higher under IFRS 16. Now let us go to accounting ratios. You have understood everything. You have to be good enough in part A. Based on that, you have to answer part B. And don't forget about your 2 professional marks. How are you writing and all? Okay, so first of all, earlier you did not recognize asset, now you are recognizing asset. I'm writing 2 columns like this. Obviously, you don't have to write like this, but this is for your understanding purpose. You can write no recognition of asset. Recognition of asset. What happens? Asset goes up. Asset goes up in a statement of financial position on IFRS 16. Right? That's what exactly they have wrote about here. Previously it was unrecognized, now it is recognized. So because of this, asset turnover will be affected. Okay? Earlier, even liabilities was not recognized. No recognition of liability, recognition of liability. Because of this, what will happen? Liability will go up. So liability goes up means your gearing ratio will go up. You see? Affects gearing. So due to that, right of use asset and your liability, what happens? Another thing. Depreciation. Sorry, no depreciation. Depreciation. So because of depreciation, operating expense goes up. No interest. Now you have interest. Finance cost goes up. So what happens? It will go up. See, depreciation earlier we told in part A, the first part, that this will be included in the operating and interest will be under finance. So because of that, operating profit, see, operating profit does not include interest, it excludes interest. That's why it will show a higher operating profit before interest. Okay. because interest is not there under operating expenses. So similarly, profit measure, which exclude interest and depreciation, such as EBITDA. Okay, this will be higher in IFRS 16. Because earlier interest and depreciation both were there in the operating lease expense. Now only depreciation is there under operating lease expense. So that interest is not there, only depreciation is there. That's why EBITDA will be higher under IFRS 16. This shows you that you have to know ratios. I have just uploaded today only the SBR formulas that you can remember. All the formulas are there. So there we have this ratio. So make sure that you go through the ratios. You cannot just study SBA in isolation. Only all the standards. You have to know the current issues. You have to know the ratios. You have to know how to analyze the company's performance. Now we are coming to the next interest cover. Okay, I'm not going to read everything. I'm just going to say you in short whether it will be higher or lower. You tell me. Okay. If you are struggling, remember, if you are struggling, you can use some numbers also to show the impact. Okay, you can increase the numbers and show that, okay, this is increasing or decreasing. That also in the exam you can do, acceptable. Because sometimes it's hard to figure out, no, where the increase is happening. It's hard to visualize. Because you're not seeing the actual input. You have to visualize, think and see. Okay, so interest is going up now. We know that, right? So it will increase what? Earnings before interest and tax. See, before you deduct interest, it will be higher. After, yes, after you deduct interest, definitely it will be lower. But for interest cover, we have to take earnings before interest and tax divided by interest. Okay. So what happens to the interest cover? See, the change in the ratio depends. Okay. Because this includes, it's affecting two places. One is your earnings before interest and tax divided by interest. No. So interest is going up. This is going up. Both are going up. So we cannot very clearly say whether interest cover will go up and down. It depends. Why? It depends on the characteristics of the lease. Number one. Number two, interest charge on the lease liability is higher in the earlier years of lease. Okay, so sometimes it's not very clear cut what is the exact impact, whether it will increase or decrease. So you can say like this, that it depends on this portfolio, the lease portfolio, and also you have to pay higher interest on the earlier years of lease. Now let us go to the second, return on capital employed. This one will be lower under this IFRS 16. Why? Because the increase in EBIT, in earnings before interest and tax, is unlikely to be proportionate to the increase in capital employed. What is the formula for return on capital employed? Earnings before interest and tax divided by capital employed. In that capital employed, it has two things, equity plus debt. Or you can take asset also. So earnings before interest and tax, this is increasing. Okay, your debt is also increasing. Because in the debt you are including the lease liability. But most of the time it has been seen that this is higher. This increase is higher than this one. It's not proportionately changed. That's why if your denominator increases, your ROCE will fall down. I will demonstrate this through a number. 5 divided by 10. It is 0.5. Half, right? 50%. Okay. 50%. Okay, let's take 50%. Now I'm going to increase this amount. 5 divided by how much should I take? Let's take 20. So this becomes now 25%. You see, I have just increased this from 10 to 20, the debt, the lease liability, and this fell down. Even if you change this also, even if you increase this by a smaller amount, 6, 7, still that impact will be not proportionate. Because we know lease interest is what? It will only be by a smaller amount. That earnings before interest and tax will increase. But your capital employed will increase by a greater amount. That's why return on capital employed will decrease. But earlier, if you see in the interest cover, it was not very clear cut because both are increasing, and it can be proportionate, it might not be proportionate. Coming to the debt to, but you can write, if you write that it will increase or decrease and justify it, then you will get the marks. You will get the full marks. Debt to EBITDA, the last ratio. Then we are going to go to the marking scheme because this is the end. EBITDA, earnings before interest, tax, depreciation and amortization. So amount of debt will increase the lease liability, correct? So EBITDA will rise under IFRS 16 because from earnings you are deducting depreciation. Now you have higher depreciation, you have higher tax, you have higher interest because of lease liability. You will deduct it from earnings and earnings will go up. And your whole lease expense takes depreciation also and interest also. So that means your ratio of debt to EBITDA will increase. Because the increase in debt will be greater than the increase in EBITDA. You see? So here also for interest cover also, if it's like that, your interest cover will fall down. If your EBITDA increase is less than your interest increase. So that's it. We have finished. Now let us go to the marking scheme. Okay. First one 6 marks. 3 marks for IFRS 10 and IFRS 11. Another 3 marks for power over the investee. You can talk about IAS 28 and also some definition that they have given, some whether they don't have a share agreement, all those things, all those points you will get marks. Second, coming to the embedded derivative. Embedded derivative and hybrid 3 marks and contract modification is 2 marks. Then discussion of IFRS 16 is 3 out of 6 and implications for investors 3. And next one is all the ratios 2. Interest cover is 2 and then rest is 1. Okay. You can show this through numbers also and the 2 professional marks. So now let us go to the examiner's comment. Is very important that you go through this. Okay. Relatively weak. First part was relatively weak when we will have to discuss about joint arrangements. Okay. Most answers focused on this standard. Which standard? IFRS 11 oldie. They didn't take IFRS 10 and IAS 28. But if they take this too, your answer would be better. You would be scoring more marks. So always see that hidden standard behind the main standard given to you. There will always be some small standards behind that main standard. Not always that main standard only you have to use. Okay. Because before you consider whether individual control is there or not. Then you see joint control. If joint control is not there, you go for significant influence. This is at what 45%. If it was 60-70%, no need to go all this. Definitely it is understood control is there. But the thing is they will always give you below 50%. So that you become confused whether control, joint control, influence. Okay. Second part was not well answered. Most of the students left it also. What was it regarding the embedded derivative? Embedded derivative. This shows people have lack of understanding in IFRS 9. You have to brush up your knowledge in this area. Third part is about IFRS 16 mainly, and this was mostly done well by the students. The older thing is what? That they have only limited their answers to 2 things. One is right of use asset and liability. That this will be recognized now. That's it. They didn't show the impact on the investor's viewpoint. Only very limited consideration for the investor's viewpoint. Okay. So because of that, the marks were limited. Otherwise, overall it was done well. In fact, better answers will be what? How the certain industries are affected more than others. Okay, because lease liability affects some industries more than others, not all industries equally. So what was some benefit to the investor? One is comparison. No need to estimate. Okay, how disclosures, how it will aid your disclosures and understanding. These are some benefits. And the last part was generally good. Impact on the ratio. Students were able to do it good. Okay, make sure that when you're showing the impact on the stated ratio, you are able to link this to the change in accounting treatment. What is the change in accounting treatment? For example, before there was no recognition of depreciation. Now there's recognition of depreciation. Earlier there was no recognition of interest. Now there's recognition of interest. That's why interest will go, EBITDA will go, EBIT will go, interest this will go. So you have to be able to link like this rather than just saying this ratio will increase, decrease, increase, decrease. Okay. So let us, yes, we have done almost. Yes, so this question is over, right? So that's it. We have finally finished crypto from your March June 2019. So best of luck and see you in next question. Question number 30.